Good afternoon, ladies and gentlemen. Welcome to HVS's global webinar, which aims to explore the question of how has COVID-19 impacted on hotel values. It's been a fascinating day. This is the third of 3 webinars, and there's been some fantastic discussion. So I hope you enjoy the session this afternoon. My name is Chris Shepperson. I'm the founder of EP Business and Hospitality, and we're proud to be supporting our good friends at HVS in hosting and organizing today's webinars. It's become almost a cliche to say that it's been the most interesting of times, but it's certainly been unexpected and full of twists and turns. The challenge today, as we look to recover, is to try to see how we can actually, and the restart is almost more difficult than the pandemic. So actually the challenges facing city centers are immense as we come back. So how will they recover? But also the challenge facing hospitality is incredibly difficult. In the UK alone, just talking from a UK perspective, the hospitality sector is looking at inflation rates of between 14 and 18%, as it faces a whole set of unique challenges. And we're finding the same challenges are occurring right across the globe. So it'll be interesting to see your feedback today as you listen to the experts. But some of those challenges are 50% increase in energy costs, 67% rise in food inflation, supply chain challenges, as you can imagine, a shortage of talent. Again, in the UK, we're looking at 188,000 vacancies at any one time. And that's going to result in lower end wages rising by between 25 to 30% in the short term. And all these factors impact, as you can imagine, on the P&L. However, as challenging as all this may appear, there are a lot of very positive signs and grounds for optimism for the recovery moving forward. In 2021, there's been a rise in investment activity across the global hotel sector, and there are many companies now beginning to look at far more aggressive acquisition strategies as they look forward to 2022. This seems to be particularly true in Asia Pacific, in Europe, and in North America. But do you agree with this? What will the experts tell us in the next few moments? In addition, investor sentiment suggests that full service hotels will endure the deepest discounts, as select service and economy-based hotels have managed to really weather the storm probably better, as they've still managed to fill rooms. In fact, many expect the best investment opportunities over the next 6 months to be in the full service sector. Again, do you agree? However, it is still likely to be a 3 to 4 year process of recovery until we return back to those 2019 levels. And many investors will want to assess alternative business models and approaches. What will that mean? And how will this create change across the hotel industry? What new services and improvement measures for profitability will emerge? How will labor models change? How will the increased demand for greater sustainability impact on costs and investment? And one of the debates about the rising energy costs that we're seeing across Europe is the fact that many are moving towards a green model. Are you seeing that in the US? Is it the same type of trend? How would digital improvements impact on service and engagement? There is still much to be answered and still much to be understood and explained. So we look forward to listening to the experts' input today. EP is delighted to be working closely with HVS. Together we've hosted 12 previous webinars, and obviously doing today's 3 as well. EP hosts on average 70 events per year and publish over 500 articles per year, as our business goal is to share knowledge and bring industry together to listen to different ideas and listen to and explore original thinking. As a result, we work with management teams and with boards to look at business strategies and trends, consumer trends across the sector, and then from that, develop collaborations and initiatives which bring companies together, because working together makes us stronger. Our role is somehow to try and create those frameworks that allow that to happen. And today's event, I think, is a classic example of what we try to do, because it is all about experts sharing knowledge with you to make us all better. So I do hope you enjoy tonight. May I at this point introduce Russell Kitt, the chairman of HVS, to come to the screen.
Thank you very much, Chris, and good afternoon, good evening, ladies and gentlemen. If I may, I would just share with you the agenda for today. And as you can see, it's completely packed. We're throwing information at you left, right, and center. We're going to talk about key changes in hotel values from all sorts of different perspectives geographically, kicked off by Rod Clough looking at the US. Then Monique about Canada, Richard will talk about Latin America, Hock will talk about Asia Pacific, Mandeep about India, Sophie about Europe, and Hala about Middle East and Africa, before handing over to Glenn Skolnick, who's going to talk about the people and talent aspects. We then finish up with a Q&A. And I'm really hoping that you, sitting in your offices, sitting at home, sitting on your boats or wherever you happen to be tuning in, will have some really interesting questions for us. Please put your questions on the Q&A button, which probably is at the bottom of your screen. Enter your question. Please don't be anonymous. Let us know who you are. And any questions that we just can't get to in the course of the next hour and 20 minutes or so, we are going to overrun the hour, so I apologize now, but you just can't cover the world in quite enough detail in 60 minutes unless we were to just go home now and hit the bar. My question to you is, what is your question? We genuinely want to answer them for you. So without further ado, please join me in welcoming Rod Clough, President of the Americas, initially to talk about the US.
Thank you, Russell. Excited about our lineup today. Lots of things to talk about. So I'm just going to get right to it. Our look in the Americas starts with the United States. That's what I'm going to be focusing on initially. And you can see from this first graph that the decline in occupancy, the decline in Revpar at 47.5% was rather drastic. What I want you to remember is that 47.5%, because later on in the day today, when you're looking at our different regions around the world, you'll be surprised to maybe learn that the 47.5 isn't really that bad compared to other parts of the world. So that's something to be thankful for. Another bit to be thankful for is that our rebound has been rather swift. You can see from the gray bars there that our occupancy has bounced back year to date by 13 points. We still have 10 points to go, but we're coming back relatively strong when you consider the big picture. ADR, which is shown in the blue line, has shown a 15% increase thus far, and that's a great start. We have $10 there that we have yet to recover. So $10 in occupancy, 10 points in occupancy, $10 in rate, leading to about a $20 change left to come to recover Revpar. The increase this year really accelerated with the release of the vaccines, and we're seeing a lot more people out on the road getting back to business, and it's a great sign. So we're looking forward to the recovery taking greater steam ahead. As you'll see on my next slide, the recovery marches forward with virtually pretty close to a full recovery expected towards the fall of 2023, because still a little bit of a weaker spring of 2023. We don't see that full recovery year really kicking in for the entire calendar year until 2024, when our Revpar hits $89, which is better than the Revpar of 2019. The faster we can get there, the better, given all of the increase in costs that we're seeing across the industry, and we have to deal with that and still maintain some profitability. So the faster we can get that rate back, the faster we can get that occupancy back, the better. What is holding us back from getting there until late 2023 is still a pullback in convention demand, large-scale convention demand, particularly in some of our center cities across the country, and also some of our center city corporate demand. as companies are still working from home, we need to get those companies back into the office and get that demand recovered from a corporate standpoint. But good strides being made for the recovery, and looking forward to having that really take place as we continue these next couple of years. The next slide, you'll see our trend in sale prices. The red line represents limited service, and a similar trend line you would see for select service. There was not that big of a dip. The demand was able to hold steady, and because of that, there's been a significant interest from investors to buy limited service, select service, and particularly extended stay hotels, because they've shown resiliency during the pandemic. And that's really kept value decreases from setting in significantly. There's been more volatility in the full service sector, not surprisingly. Resort locations are very, very much sought after, and some of the more urban properties, convention properties, haven't come to the market, haven't traded necessarily. And so we haven't seen any kind of significant decline setting in for those yet. So we might see some volatility going forward as some transaction activity continues into next year. But limited and select serve have definitely proven to be the positive signs. You'll see in the next slide that the recovery is happening relatively quickly in the current cycle compared to the last. We may see another dip in values next year if more of the problematic assets come to market. But nevertheless, the bounce back this year has been good and has been strong. Moving on, our value impacts. You can see how the recovery is. The worst part is certainly behind us, and we're well into the recovery. Sometimes some of the more visible center cities that are struggling get more of the press, but out in tertiary markets and secondary markets and suburban markets, many of these markets have fully recovered, or even are doing better now from a value perspective than they were pre-pandemic. So when you take this broad brush and you look at the market as a whole, and not just those still problematic CBD markets, we're doing well in the recovery and headed back towards that full recovery timeframe in that 2024 period. The other thing to keep in mind that's important to note is the hotel sector's favorable in that it's rebounding so quickly. We have people traveling again, people wanting to travel, and some of our other sectors that investments may have flew to during prior downturns, such as retail and commercial office space, maybe aren't quite as favorable this time around with the advent of Amazon and with the decline in the American shopping mall. There's a little bit more of a tenuous atmosphere around retail, and with office space, with so many more people working from home, and maybe the need for such substantial leases in the office sector has a little bit of a question mark over that sector as well. So this time around, hotels are able to bounce back quicker, can change their pricing quicker to deal with inflation. And therefore, we're seeing a flight of interest to this sector in terms of capital and people wanting to get in. So that's something that's really going to help the industry bounce back and values bounce back. And we're seeing that in a couple of the sectors of the industry, like I mentioned previously. On our next slide, you will see that we had a very strong second quarter. We had a couple of big portfolios come to market that quarter. Quarter three had a little bit more of a normalization, and we're looking forward to a robust 2022 with hotel transactions. Should be a very busy year, very active year. So looking forward to that. Moving on to the next slide, this active 2022 will be supported by the availability of financing that we're seeing for well-capitalized buyers. And predominantly in that 65% LTV range for transactions that are in the $25 to $75 million range. The more, the smaller transaction that you get, you might be able to get a better LTV. loan to value ratio. And the bigger transaction you get, it's going to be virtually impossible to get the big loan. And some financing might not be available for the largest of transactions. So availability of financing is back, and that's certainly going to help the industry next year and through the recovery. Our pricing is still off. In that red bar, you can see that the biggest red bar there is our pricing is off about 5 to 10% of where we were in 2019. And that's being driven primarily by the blue bars that our Revpar hasn't recovered yet fully. From a discount rate perspective, from a lending perspective, those factors are back to where they were before. We're seeing cap rates that have fallen back to 2019 levels. Discount rates are back to 2019 levels. But when you layer in cash flow that isn't quite yet recovered, that's going to impact value. And thus we still have values that are down in that 1 to 10% range. Some markets are going to see values off even more than that still, some of those markets and particular properties that haven't recovered yet. And other markets are going to be in the positive range because they've fully recovered. Their cash flows are now better than they were in 2019. And when you layer on a favorable cap rate, for example, our limited service cap rates are even lower than where they were in 2019. In 2019, they were at about 10. And right now on average, we're seeing at about a 9 cap rate. When you layer that on top of even stronger NOI, the value story there is very good for those properties. And my final slide before I turn this over to Monique, you can see that not surprisingly, our investor interest is hottest for extended stay and select service assets right now. Very hot in the US. Everybody's looking for those portfolios in particular, and limited service is not far behind. Folks are a little bit staying away right now from those convention properties and the full service center city properties as well. That is it from me. Thank you very much. Monique, I'll let you take it away.
Thank you very much, Rod. So I will begin with looking at the Canada lodging market trends through prior cycles, just to give some perspective to COVID. And as you can see, over the last 20 years, one of the disruptors, the biggest disruptor that Canada had was in 2003 with SARS, where we lost about 14% of our Revpar. And that was followed by the next disruptor in 2009, where we lost almost 11% of our Revpar. We also experienced the Alberta oil crisis in 2015 that had a little bit of a dip, but obviously our 62% decrease in Revpar in 2020 is by far the greatest. And as Rod mentioned, the US has a decrease of 47%. Our 62% would be as a result of greater lockdowns, more travel restrictions, and having the US border really did affect our Revpar decrease. Next slide, please. So Canada is about 1/10 the population of the US, and we actually have about 1/10 of the lodging inventory. So our markets are very, very correlated. There's usually about a 6-month lag. Whatever happens in the US then affects Canada. So this slide just shows Canada in the red, US in the blue. SARS, obviously our Revpar decreased where theirs didn't, because the epicenter was in Toronto. Mind you, it was only 400 cases, which seems like nothing compared to COVID now. In 2009, the debt crisis, the US was more greatly impacted than Canada, but came out much more strongly and performed stronger than Canada did right through 2015. Then starting in 2016, Canada's Revpar growth was greater, and this had a lot to do with displaced conventions from the US where attendees could not get visas. A lot of those conventions and meetings came to Canada and enabled us to grow our Revpar at a stronger rate than the US. Then you can see the decrease in 2020. And the US, as Rod mentioned in 2021, is coming out more strongly than Canada again, because of less restrictions and lockdowns. How does this translate into our projections for the Canadian market? If we look, Canada has always had an occupancy sort of between 64 and 66%. In 2020, that occupancy fell to 31%. This contributed to the 62% decrease in Revpar. 2021, we're looking at a 26% increase in comparison to ROD's 45%, but we now have about 83% of all adults over the age of 12 vaccinated in Canada. So next year we're looking at double that growth, 51%, strong growth in 23, and back to pre-COVID levels by 24, 25, very similar to the US. What I find interesting on this slide as well is the green area. Pre-COVID, we had about 24,000 rooms in our pipeline. The market was very frothy prior to COVID with new supply, particularly in central and eastern Canada. And what we're seeing post COVID or during COVID is that we still have that 24,000 room nights, but it's coming in between 2020 and 2025, which shows the confidence in the market. Projects have not been canceled, they've just been delayed. So in comparison to the US, just to show you, we typically have had very similar occupancies. Now, the US average rate is in US dollars, Canadian is in Canadian. That's why there's quite a differential there. But as you can see, in 2021, we are below the US, but we catch up gradually as our Revpar growth is projected is much stronger in 22 and 23 than the US. But you both get back to the same levels of Revpar by that 24, 25 year period. Next slide, please. So which are the cities that are growing fastest Revpar growth? It's definitely the leisure markets, and particularly in Western Canada. Western Canada had less restrictive lockdowns, and it also, it's got warmer weather, so they got a kickstart on the summer season. And so you can see Victoria, Abbotsford, Vancouver, all in British Columbia. Niagara Falls, a leisure market. Once the US border opened up, that helped. And then the Montreal airport, it had a lot of mandatory COVID quarantine demand, which helped it to push up its Revpar. Slowest growing Revpar, urban cities. I think that's a global phenomenon. Toronto down a further 21% in 2020. Ottawa, Regina was kind of struggling before COVID. Montreal actually managed to get a 1.3% increase so far through September year to date. And then Mississauga is a Fortune 500 corporate hub, and with the US border closed, it has really struggled to get back its lost demand from 2020. If we move on to the next slide showing Canada average price per key in past investment cycles, the height of our investment was in 2007 with a lot of REIT activity, but the height of transactions in Canada was in 2016 with 300 trades. We've been on a downward trajectory since then. In 2020, we only had 71 trades, and year to date, 2021, mid-year through June, we were at 40 trades. So there have not been a lot of properties that have traded, not a lot of receivership situations, because the government has provided substantial wage subsidies and mortgage subsidies to hoteliers. So there isn't a lot of cap rate data out there, but the volume of appraisals that we're doing, depending on the type of market, obviously urban markets are more hard hit, but secondary and tertiary markets, extended stay product, we're not seeing a lot of pricing differential from pre-COVID levels. There's a lot of liquidity in the market, and there's a lot of appetite to buy hotels the further we get from COVID. And now I'm going to hand this off to my colleague in Mexico City, Richard Katzman. Thank you.
Thank you, Monique. Good afternoon to everybody from Mexico City, from where HVS manages our practice for Latin America. As all of you will know, Latin America is a large region and a varied region, with countries that go from a few 100,000 to over 200 million people. So it's a little bit difficult to make sweeping statements about the region as a whole. What I'd like to try and do in my presentation is share with you some of the structural elements and some of the drivers of the different markets, comment on that, and also identify where some of the obstacles and opportunities are in different countries and a sample of different countries. And then we'll come on to some commentary just about the recovery and what we might expect in the future for Mexico as a proxy for the region. If I could have the next slide, please. Mexico is an interesting country in that one of its strengths is it has a really strong urban/industrial market, as well as a strong resort market. The industrialized parts of Mexico in the central and northern part of the country, which are tied to what was NAFTA and is now the ratified North American trade agreement, are doing fairly well and in a good recovery mode in the limited and select service, not unlike in the US, whereas the recovery period for urban hotels in the major cities has been a little bit more difficult. Our resort markets have recovered significantly, rapidly. The drivers have to do with our proximity to the US and what has been the increase of a very high quality footprint over the last 15 years. We'll see a little bit more about that in a couple of minutes. We see a great deal of appetite, not a lot of trades in urban areas, not a lot of a slowdown in investment in urban areas. A lot of those got increased footprints of branded hotels over the past 10 to 15 years, and therefore that's slowing down a bit, but we see considerable appetite and investment in resort markets across the board. If I could go to the next slide, please. Just by way of example, Costa Rica and Panama have different drivers. Panama, of course, is driven by the Panama Canal and banking industry. In Costa Rica, there's the agriculture and the service and tourism. I think what we're seeing is gradual opportunities for increase in inventory in certain parts of Costa Rica. In Panama, what's interesting is that there's a lot of redevelopment of the old central part of the city, which is a trend that we find across Latin America, opportunities to redevelop in these historic areas, as well as opportunities to invest in boutique hotels outside of Panama City. For South America, if I could have the next slide, and we'll review this quickly, there are different drivers in different countries, as you'll see, from agriculture to mining to agro. There are opportunities for growth along the coastlines in each of Colombia, and Ecuador, and Peru. In Colombia, there is a large area that goes from Cartagena to Barranquilla, where there are beaches that we anticipate will have increased development over the next few years. There's under review and study is additional resort development in the south of Ecuador and the north of Peru. So that's something that will be interesting to follow by way of opportunities. I could have the next slide, please. Argentina, Brazil, and Chile are a little bit different. They have, again, different drivers. Argentina is more agriculture driven. Brazil has this large domestic market. Some of these countries are driven by mining and commodities. And so you really have to follow the drivers in each market to be able to understand how they impact the lodging industry. Across the board in these countries, it seems to us that over the next few years, there will be opportunities and interest in increasing the inventory of limited and select service branded hotels. And there'll be additional opportunities in some tourist markets, particularly in Brazil, where financing trends are different. I could go to the next slide, please. By way of understanding recovery trends and their impact, Mexico We've done two slides, one that addresses business lodging at the top, another that addresses leisure lodging at the bottom. And what you'll find is that in 2020, like in other countries, we had Revpars dropping off as much as 69% in business markets, and as much as 52% in leisure markets as aviation shut down and international travel shut down. We expect a gradual recovery in the business environment, again, more rapidly and already underway in limited and select service in industrialized cities in the central and northern parts of Mexico, slower in the major urban centers with larger hotels, consistent with other markets around the world. Interestingly, for the resort markets, we've seen a fairly rapid bounce back in overall demand. We also, though, have a lot of supply coming online. So as you look at the occupancy projections for the leisure sector, you find that they take a little bit longer to recover than would be the case if we didn't have a lot of supply coming online. But interestingly, also, average rates have pretty much held up in those markets, and that's going to help Revpar to recover relatively rapidly. I'd like to share one more slide with you before handing off to my colleague Hawk to talk about Asia Pacific. This is an interesting slide in that it shows you a column of available room nights, pure supply, occupied room nights, pure demand, and this is a trend line for a dozen years. And what you find in Mexico is that demand has tended to keep up with significant additions in supply. We add a passenger traffic column as sort of a control, but what you find is that this is a market that's evolving, that is growing, but demand has tended to keep up with supply. The importance of Mexico for the rest of the region is that while all countries in the region are different and have different drivers, Mexico can serve as an example, as a sort of proxy that in some measures across the region, some of the examples and some of what we learned in Mexico can apply to different regions. With that, I'd like to, and I'd be happy to take questions if we have them later, and I'd like to hand off to my colleague Hawk, who's going to talk to us about Asia Pacific. Thank you very much.
Hawk, you able to join us? I know it's something like
yes.
2:30 in the morning.
Hi, sorry, I was on mute. Good afternoon, good evening. As I was saying, let's take a look at the Revpar performance. In Asia Pacific, there's a drastic drop in year 2020 during the COVID as compared to the global financial crisis, where the decline was about 20%. But last year it was close to 50. And actually by now, in 2021, there is already a moderate recovery, somewhat a growth of about 21% compared to last year. Now, this, when we go down to the various markets, we'll find that actually the top performing markets in Asia comes from actually those with the positive occupancy and ADR. And these are the markets like Beijing and Shanghai, where there is large domestic market, and also Sanya, which is a leisure market in China. Now, the least growing or the slowest growing Revpar is actually also the leisure markets of Phuket in Thailand and Bali in Indonesia. These are also leisure markets which are more highly dependent on international travelers. The transactions volume last year also fell by 42%. You can see the number of transactions are low, and also the transaction volume has come down significantly. What is worthy to note actually is despite this decline, Australia actually has seen an increase in the volume of transactions. So in Australia, for the last year, actually there were 84 transactions, and their volume of transactions was something like, from 0.76 billion to about 2.2 billion. So it's a threefold. You'll find that, Russell, can I have the next slide, please? Yeah, you see the transactions here. So the three most active markets is actually Australia, China, and Thailand. But Australia, there's a huge number of transactions, and the volume is very high. And despite it being COVID, there are a couple of transactions noteworthy to note in North Asia. We have a transaction in February 2021 in Seoul, the Le Méridien, which was sold for 1.9 million a key. And in July 2021, there is the Tokyo Tower in Japan that was transacted for 5 million US per key. So actually, and as we are speaking now, there are a number of hotels that have been put on the market in the Maldives as well as Australia, and a number of transactions actually are close to being transacted, I think, before the end of this year. So despite Revpars being down, there is a fair bit of transactions going on, and actually these are really not distressed transactions as well. Let's talk about the value. So in terms of value, you will see that values have declined, actually bottoming out in 2021. Somewhat the decline is from the year of 2019, varies between the three regions here: Northeastern Asia, Southeastern Asia, and Australia and Oceania, somewhat between -13% to -18%. And we are looking at a value recovery by year 2024 at the very latest. That is all from Asia Pacific. Over to Mandeep for India.
Thank you, Hawk. Very good morning, America, and hello to everybody else from across the world who's logged in today. I hope you're finding some of the facts and figures and data that we're sharing with you from across the world interesting enough. And I hope that we have an interesting Q&A session after we finished all our presentations. I'm going to quickly talk about India. Just like most parts of the world, actually almost all parts of the world, we saw a very, very steep decline with the impact of COVID in the first year that it hit us, down by almost 57%. The last decline was 16% when the global financial crisis hit us in 2008, 2009. We saw occupancies going down to the same period last year, 33%. We've grown by about 10 percentage points calendar year up to September this year to a little over 42%, which is a 10 percentage points increase. There is a gradual recovery that is taking place with the vaccine now crossing 1 billion vaccines across India, the largest in the world, with almost 70% of the eligible population having had one single dose. We're expecting the recovery to be much quicker than what it has been in the last few months. Our year-to-date revenues are hovering between 45 and 50% of pre-COVID levels. That's where India stands at this moment in time, and we think that we gradually start recovering. We think occupancies will see pre-COVID levels around the middle of next year, and we think that Revpars will reach pre-COVID levels around the middle of 2023. Leisure is the sector that is leading recovery, as it is in almost all parts of the world, barring some destinations in Asia Pacific. Staycations and workation, or working from home, which is getting modified into working from various other places, including hotels, is the significant newer filler of business for a lot of city hotels. Can we go to the next slide, please? In terms of transaction values, we saw a decline of almost 50% in 2020, which was last year over the previous year, from about $700 million to $350 million in 2020. And surprisingly, despite all the pain in the sector, and unlike mature markets where you would probably see a whole lot of transaction opportunities taking place in this kind of environment, we haven't seen any significant transaction take place in this calendar year, which leads us to believe that a lot of stressed properties, those which are highly leveraged, and there are quite a few of those, will come into the market very soon towards the end of this year, and we're likely to see an uptick on the transaction volumes starting next year. Go to the next slide, please. Typically on valuations again, while we've not seen any significant transactions take place, we do think that property values are down anywhere between 20 to 30%, but transactions are not taking place because of the mismatch between what buyers are expecting and the sellers not being able to match that expectation and holding on at this moment in time. We think that values will come back to pre-COVID levels somewhere towards the end of next year, and then we'll start seeing a little bit of a rise in 2024. And beyond that, we do think that the valuations for hotels in India will see a reasonable increase in the way they're valued, and we're likely to see much more trade happening over the next few years. Thank you very much, ladies and gentlemen. I'd like to hand over to Sophie, who's going to talk to you about Europe.
Great. Thank you, Mandeep. Hello, everyone, and on to Europe. So Europe has had many lockdowns in 2020, and as a result of that, Revpar was down by around 70%. So that bad. We also had a very slow start to 2021. Until the summer, really, occupancies were under 20% in the first quarter. And we started to see a bit of a recovery around the summer with strong performances in resort destinations, think Italy, France, or markets that had strong staycation trends, such as the UK. The September 22 data, the September 2021 data is very encouraging. It's showing an improvement in performance vis-a-vis the same period of 2020. And this is supporting the sort of forecast that we're putting forward in terms of Revpar recovery as presented on the graph. We think Revpar will be back to the sort of 2019 levels by around 2023, 24, depending on the dynamics of the particular market we're looking at. So on to the next slide, please. And we can look at the particular dynamics. These are two very interesting images. It's like mirror images of themselves. So we have on the left-hand side, the year to September data for 2020, and we can see that dramatic collapse of Revpar by April, May, when all of these lockdowns started to be implemented, and a very flat line performance for the rest of the period, really depressing. In 2021, we have very much the opposite, a very slow start to the year. And around the summer, performance starts to pick up. And we've selected a sample of markets here. We wanted to show the very strong recovery by some of the key markets here in Paris, London. We can see a steep recovery there, and these recoveries are really driven by very many things. There is small meetings and events taking place. There's fashion shows, sporting events. There is as well the staycation trend and leisure over the weekends. Those leisure guests are actually paying very full rates. So this is very encouraging. And other markets at the other end of the spectrum are experiencing a slower recovery, maybe because they have greater exposure to international demand sources like the US or the UK, which have been subjected to more stringent travel restrictions. Next slide, please. So in terms of value recovery, what we've seen over the last 18 months or so is that for the most part, values declined between 5 and 15% in Europe, but obviously we have outliers at both sides of this range. But we consider that values have now bottomed up. We can see strong Revpar recovery that I mentioned before, combined with some very serious cost cutting that has taken place across Europe, helping to prop up margins. In the back of that, however, I have to highlight there are some pretty important headwinds that we see coming up, wage pressure is one of those, inflation. These are not challenges to be underestimated. We expect, however, that value recovery should have taken place for the most part around 2024 in Europe. In terms of value transactions, again, very steep decline in 2020. Volumes were down for around 70% on the year before. The Q3 data for 2021, however, is quite encouraging. We can see transaction volumes there up by around a quarter on the same period of 2020. And while the bid-ask gap still remains very wide, that we've seen very little in the way of distressed sales taking place. And the very significant levels of equity that were raised in 2020 mean that there is massive competition for assets, the few assets that come onto the market. And this effectively what it does is that it has a very limited value, a result in very limited discount on values as compared to the 2019 levels. Appetite for resort markets remains very strong, and this list of the notable transactions in 2021 is a very good reflection of these. As you can see, we have quite a few transactions actually taking place in Spain here. The most notable of these transactions, however, is a portfolio of 12 Hilton hotels purchased by Henderson Park by more than $500 million. But I would just highlight one more thing out of these transactions, which is quite exciting. We have here repositioning opportunities in the way of the Grand Central Hotel in Barcelona or the Park Lane Mews in London, and even a development, which is the addition in Madrid. So I think this just highlights the very strong appetite for these markets and the faith in the recovery of these markets from the investors. And with this good note, I'll hand over to Hala. Thank you.
Good evening from Dubai, and thank you for joining us. I'll just finish up with our hotel outlook and value recovery for the Middle East and Africa region. I mean, similar to what we have seen through the remaining parts of the globe, the Middle East has also observed a significant downward trend in both demand as well as Revpar in 2020. Specifically looking at the Middle East and also at Africa, we have looked to break it down into different sub-markets simply because they have a different demand characteristic, but more importantly, perhaps also different recovery timeline. We have clearly observed some cities in the GCC performing much better on the back of either domestic tourism, such as in Saudi Arabia, or for instance, Dubai and their ability as a UAE for the containment of the pandemic, but also their rollout. So these are the destinations that have actually started recovery in 2020 and well underway in 2021. Added to that in the GCC as well is Doha, with capitalizing a good base of corporate demand, and especially as demand relates to the World Cup that is taking place in 2022. In contrast, when we look at Africa, it's a bit of a different story to tell there, from the point of view of the vaccine rollout and the containment of the pandemic, which has certainly slowed down recovery, and we have seen very little recovery take place in the African continent as a whole, with the exception perhaps of Egypt, Cairo in particular, as well as Seychelles. Now, when looking at Egypt, domestic demand has always fueled quite a good and healthy base of demand in Egypt. So barring that international travel was limited, they were able to sustain relatively good occupancy levels. Seychelles in particular, it has been described at least within the 5-hour travel radius as the revenge holiday destination. So these markets have definitely performed better in the African continent. What is important, however, also to highlight, when we look at the historic performance in the Middle East and Africa, average occupancy has hovered around the 64% with an average GCC average rate of $230 and in Africa, $130 when excluding Seychelles and Mauritius that typically are significantly higher average rate. In terms of the new supply that has entered the market, for instance, if we look at Dubai specifically, in the last 5 years, the inventory in Dubai has increased from 40,000 keys to 120,000 keys. And what we're expecting now, in line with the Vision 2030 for Saudi Arabia, that is similar growth in number of rooms will enter the Saudi market, but also perhaps to a lesser extent still the UAE and other markets in the GCC, which as a result, when looking at projecting Revpar growth, while we are pretty much confident that all markets will recover in 23-24 in the GCC to pre-COVID occupancy levels, in Africa in particular, while recovery will commence in 2022, and again, subject to the vaccine rollout, but more importantly, also to the government support of the sector, that full recovery in terms of occupancy will be achieved by 2025. With the same rationale with regards to Africa, we do forecast a much more aggressive growth in Revpar by 2025. This may not necessarily mirror what we anticipate for the GCC markets. We believe that while Revpar will certainly recover by 2025, it will be a much softer recovery on the back of the additions to supply that is anticipated over the next 5 years. So what does that mean in terms of value change? What we have seen in the key 20 cities that have been considered in the Middle East and Africa, the Middle East average in absolute terms in 2019 was roughly around US 250,000, with the Africa average being 200 US thousand. So on average, we're looking at $220,000 per key. This has dropped, or is forecasted to have declined by 18% by the end of 2021, but that most of the markets will eventually recover, with the exception of few markets being Panama and Kuwait, on account of a pretty much stagnant occupancy growth and a further declining Revpar, as well as rising costs. So when we look at the fastest value growth on the next slide, the clear winners are Riyadh and Doha, with some 30% growth in value, and 28 for Doha. And in Africa in particular, we're looking at Abidjan, Cape Town, and Nairobi, with this smallest value growth being registered in Kuwait and Panama. And just to conclude with regards to the transaction market, unlike Europe and the US, but more in line with India, there has been no transactions in the market, with the exception of the address portfolio, 6 properties that have transacted, but they pretty much exchange hands from the Dubai government entity to the Abu Dhabi government entity at a price point of roughly 450,000 USD. This relates to the ownership structure of these assets, especially in this part of the world where it's predominantly most of the strategic assets are owned by the government. Perhaps also more importantly is that the government did support, at least in the initial 12 months since the outbreak of COVID, some of these hoteliers, as well as facilitating deferral of payments and incentives from the banks. And with that, I'll pass on to Glenn. Thank you.
Thank you so much. Russell, are you able to allow me access to start the video? Looks like you had stopped that.
You should be able to start your video yourself, please.
It says that you cannot start your video because the host has stopped it.
Okay, well, Lauren will do what she can, please. If we can't see you, then I would suggest you continue in sound only.
Okay, so why don't we just wait a very brief period of time here, and if that doesn't work, I'll speak without the video.
You can see the screen, presumably.
Okay, so I'll just go ahead. I'm not sure if you're able to see me on video, but hello, everybody. My name is Glenn Skolnick, and I'm from HVS Executive Search, and I'm going to discuss the key impact on people. So a major challenge we're currently seeing in all industries in the Americas, and especially in the hospitality industry, is, of course, the huge labor shortage. In fact, the CEO of the U.S. Chamber of Commerce said recently that the worker shortage is a national economic emergency. U.S. labor statistics, feedback from hospitality industry executives, and our experience here at HVS Executive Search all speak to this. So why is talent leaving the hospitality industry? Well, first, workers in the hospitality industry quit their jobs in August at a rate of 6.8%, which is more than twice the national average of 2.9%, which is also a record, according to the US Bureau of Labor Statistics. So in terms of some of the reasoning, attractive wages outside the hospitality industry is luring people away. Some people are burnt out by the industry's long hours, and other industries are offering more of a higher quality work-life balance, including flexible work hours as well as remote. One recent example that sort of speaks to this is, it's one of many, of course, is Amazon came out the week before last and said they're now going to allow a large portion of their employees to work remotely indefinitely. This after they had previously said that most employees would need to be back in the office at least 3 days a week once offices reopen in January. So that's relevant to us because it just sort of sets the tone, and there are many other companies that have already followed suit. So more evidence that trend of remote working is here to stay. So what matters most to employees when choosing a job? At the top of the list, long-term rewarding career path. According to a survey of 2,000 employees done by Prudential Financial, 26% of those surveyed said they're planning on switching jobs this year, and 80% of them are doing so because they're concerned about career advancement. Remote flexibility is up there as well, already discussed. But overall, employers are going to have to be mindful of what matters to their employees, seek feedback from them, and reward those strong performers accordingly. And then just moving to what employers have to do to retain talent. Employer-related benefits is important to employees. In a recent Robert Half survey, 8 in 10 workers considered benefits, including retirement plans and health and life insurance, as critical. Increased compensation, a trend that is impacting the industry already. Company culture, also important to retain employees. Companies are going to have to maintain an organizational culture that inspires employees, fosters growth, offers things like continuous learning, and ultimately makes it a place where people want to go to work. Of the 26% of the employees in the Prudential American Worker Survey that I referenced, the ones that are considering leaving say they plan on, the main reason that they want to leave is, organizational culture is not really to their liking. Next slide, please. Trends in the hospitality industry. Hotels are employing fewer workers while wages are increasing. In August of 2021, hotels employed 17% fewer people versus pre-pandemic levels, and wages were up 13.3% over that same time period. That's up to $20.83 per hour, also a record. Hotel owners are reducing service levels to offset increased labor costs. Host hotels and resorts, among others, is now asking guests to request daily room cleaning rather than automatically providing it. They've also discussed eliminating hot breakfast buffets, but ultimately they're going to have to find the cost reductions, and they're already doing so. Digitalized guest experience and contactless technology. According to Moody's Analytics, business investment in information processing equipment rose 16% through June of 2021. That's after growing 4% over the previous 10 years. So just a huge increase. It just means that people already are investing in a significant way here. And at the property level, that would include things like mobile check-ins, contactless payments, tablets for ordering foods at restaurants, and so on. Another trend, increased focus on hygiene and sanitation as a result of the pandemic, and we're already seeing this. But as a result of the pandemic, the industry wants to help guests feel safe. Staff is continuing to learn different skill sets. Some hotels are employing hygiene managers, utilizing quality control circles more frequently. Next slide, please. People and trends in Latin America. Latin America has been slow to recover overall, although, as Richard mentioned, there are great disparities between countries. Increased hiring has been taking place at those countries that had government assistance throughout the pandemic. But overall, the similar hospitality trends exist in Latin America relative to North America for all those countries that are experiencing more of a rebound. And then with that, I believe I'm handing it back to you, Russell.
You are indeed, and thank you so much to all our presenters. And if they would please now rejoin on the screen and with cameras and sound, we'll move into our Q&A. We're going to have more people on screen than we've done at any other time. And I'm pleased to welcome, in addition, some people that you haven't had the pleasure of hearing already, Vicki Richmond and Kirby Payne from HVS Asset Management, in case we've got any operational related questions, and Eric Guerrero, who's from our brokerage team in the Americas, will also be answering questions that might relate to transactions and so forth. But I'm going to kick off. I've got a ton of questions that I want to cover that delegates have come through with. And I'm going to kick off with one from the only one of the people who put a question in who I recognize because I've known him since he was a young man and I was a young man. He says, "Dear HVS team, this is Jan de Roos here from Cornell University. My question is whether values will be driven more by expected or perceived changes in property EBITDA or by expected or perceived changes in required returns or cap rates." Why don't we start with Rod? Take Jan's question.
Hello, Professor de Roos. It's been a while. Thanks for that question. I think we've really seen cap rates and discount rates fall with the market in the US with so much investor interest. So I'm not sure how much more further they can fall. So I do think that value increases are going to be driven by some changes in the EBITDA going forward. And also what pricing increases can be gained through the inflationary pressures that we're dealing with right now. So I think you'll see it mainly on the cash flow side.
Can I ask my colleagues from around the world, Hock, any difference in the way you would answer that question in Asia Pacific?
I think very much the same as Rod. Already in Asia Pacific, the cap rates are fairly low. It's probably more dependent on the inflationary rate and maybe the cost of borrowing. And ultimately, it's still back to EBITDA.
And the same question for Sophie. Anything to add from Europe? Hala, anything from the Middle East? Mandeep from South Asia?
Sure. I mean, on that point, I would agree with the previous participants that the cap rates have remained very low in Europe. However, we have seen discount rates going out, and I don't think we have returned to the pre-pandemic levels from that perspective. And so in combination with that, we have the rebuild of the cash flows, as it were, which continue to impact values in the short term.
Okay. We're blessed with questions from our audience, and if you have any more, please don't hesitate to raise them. I'm going to stay with the valuation theme, and banks rely on appraisals for valuing for the hotel portfolios that they have. The lack of individual sales has therefore forced the appraisal companies to rely on pro forma judgments to enable values to be stated. Is there any consideration to look at debt sale prices within the appraisals? So Monique, Rod, answer this perhaps from a North American perspective, please.
Yeah, in Canada, we haven't looked at that in order to determine. So I would say no at this point.
And Rod, are you in violent agreement?
Yep, well, in agreement, yes.
Yeah.
Wonderful. A question again, will the difference continue between values of similar central business district hotels versus suburban hotels due to remote office work, sluggish convention business, and social unrest business? Anybody like to take that question? Otherwise, I will volunteer you. So you have to put your hand up. Go on, Mandy.
I can go. So we're seeing the CBD hotels. They're really not trading right now because the cash flows don't support, values don't support sellers wanting to let go of these assets at such deep discounts. So If anything, they're looking for new equity partners. They're looking for ways that they can hold on to the assets and just wait for that recovery to set in. It is being delayed. I think the social unrest issues were hopefully, knock on wood, a thing of the past, a thing of last year. We're really moving on beyond that in the US. And now just needing to get back to life as normal, getting back to traveling and meeting.
Okay. To what extent do the Revpar calculations take into account inflation? And our questioner goes on to say, from the masses of money put in the economy in the past 1.5 years, i.e. a Revpar of $85 in 2019 has a greater value than a Revpar of $85 in 2022 or 2024. That can only be a question for you, Rod.
So that's why I mentioned during my presentation that it would surely be nice to get to that $87 2019 Revpar very quickly, because we need to overcome that to deal with these pricing pressures and inflationary pressures. So that's a very good point, and we need to move well beyond the 2019 level in order to deal with that.
Okay, and just one other question, would any of the panel like to come in on any aspect of that whole series of questions that we've just dealt with on behalf of our esteemed audience? Anybody else got anything to add before I go on to something else? Okay, go on, Monique.
Russell, I was just going to say, there's no question that we have not factored inflation into our Revpar projections. So if you do deflate them back to 2019, it is going to take some time to get back to the 2019 levels.
Right. Okay. I think I'm going to move on and change the subject a little bit. I wish I was choosing a different subject for Rod, but maybe I'll throw it open and see if anybody throws their hand up. What effect has the Delta strain had on the hotel investment community? I'm looking at the United States, obviously, but anybody else in the world who wants to pick up this question and answer, go for it.
We could have Eric maybe chime in on that from his perspective.
Okay, Eric, go for it.
Yeah, so from the transaction perspective, I mean, we did have investors that were concerned with how to underwrite, the recovery, because they were very aggressive with underwriting recoveries through the summer and the winter months. They pulled back a little bit in terms of the underwriting, but ultimately it did not impact transactions on a major level. Pricing actually continued to increase, investor demand continued to increase, so there was no major impact.
Okay, I'm going to ask a question and I'm going to broaden it and make it applicable to absolutely everybody. So you're all going to get a chance to answer. And for that reason, your answer needs to be very short. So keep it to one sentence. With what we're seeing, and everybody talks about, we're talking about supply of people being one of the most critical issues. I'm sure we'll continue to hear this. So what does the global hotel industry need to do to build back the labor supply? Easy question. Think about your own area of expertise and where you're physically located. What does the global industry need to do to build back the labor supply? I'm going to go across my screen in the order that it appears, and Richard Katzman happens to be at the top right-hand corner. So Richard, you kick us off, please.
Sure.
Short answers. Everybody short.
I think there's a difference between some of the mature economies in the United States, perhaps Canada, and some of the European economies, and those of us who live in emerging economies where labor tends to be in greater supply, where wages tend to be a little bit lower, and where the emphasis is still on developing footprints, on training people and getting them into the pipeline. And I think that's going to be a little bit different from what we hear from countries in, with more mature economies.
Okay, Sophie, you're next, but you've got to choose something that hasn't already been taken up by Richard. I don't want anybody to be just repeating.
Right. No, I was just going to say that there's probably a need for the readjustment in wages that is effectively taking place at the moment, because this is perceived as a very unsexy industry to work for, and we need to change that perception, and starting from us. important.
Okay, thank you. Glenn, something fresh.
Okay, well, I named about 7 things in my presentation, but we'll go with, ultimately, you have to make it you have to inspire these employees. You have to make it a sexier, a proposition, and longer term, show that advancement. And at the end of the day, as the industry comes back and they could fund, the costs associated with that, that'll also help. Okay.
There's rather too much sex coming into your answers. Rod, please save us and stick to something clean.
A new item for conversation is to the US at least, to get back to opening our borders. Our hotels are very much dependent on immigrants, and it's often a first stop in the labor movement. As you come into the country, you work in the hotel industry. So great to see we're headed on that path, and that will be very helpful.
Okay, next up, Vicki Richmond.
So I'd have to say the supply itself hasn't really lessened but they have left our industry, and they've gone to either other industries or started their own businesses, or some have retired, but mostly they're young and they've left our industry. I think we need to drill very, very minutely, granularly into each position and find out why they've left, because there's a whole wide variety of reasons. So you can't, it's not one broad swath to have to solve it. You have to drill into each position, each individual's reason to address it. There's any number of solutions, and sometimes it's a combination of them. So okay. I wish I could come with one. So
okay, Monique.
I would say that with young people today, work-life balance is incredibly important to them. And the hospitality industry doesn't necessarily offer that in the way it is currently, but just small changes, for example, not having to work every weekend, but maybe every other weekend or every other evening, just giving that flexibility will draw people back.
Okay, and Kirby Payne.
I think the industry needs to remember that it's competing with other industries for a reduced labor force. So we really need to consider what it is that appeals to employees that are considering working for us, that they have alternatives in other businesses. And I don't mean to include restaurants or fast food in that. I'm talking about warehousing and whatnot, as people have alluded to.
Okay, Eric, do you have something to add on this subject?
Yeah, I'd say on my side of the business, we need to have more deals, and we're heading in that right direction. But I think on the equity side, they're compensated based on how many transactions they're able to close. On the brokerage side, the same thing. So as long as the transaction market continues to stay hot.
That's what I like about Eric, ever the subtle person. Mandeep, how are things in South Asia? And what do we need to do to get our people back?
So in India, one of the things that's happening post-COVID is that, the industry is realizing that we were highly skewed in our room to staff ratios, and, we were overstaffed. And we're certainly going to see a serious reduction in salary and wage costs going forward. I think what the industry, and we're really hoping that the industry passes a part of the saving back to improved compensations as a retention strategy, and therefore not losing the young people we're losing to other industries.
Okay, Hala, something to add from the Middle East?
Sorry, Russell, I can't follow your instructions. I have to echo what Richard said, but I will add that while we don't have a, I know, right? While we don't have a shortage in manpower, the biggest challenge or expensive item would be training and the retention of employees. So while it is available, I think the challenge is going to be with all the hotels opening up. How do you retain them? And how do you keep them? And more importantly, how do you train them? And what we have observed in the last 18 months, simply because of closing certain visas and opening different borders, we have a whole untrained employees in hotels and really impacting the service and the quality.
Okay, and
Russell,
finally on this question,
Russell, if let
Hock have her words, and then if it's still relevant, then come back, please.
Okay, I think across Asia Pacific, it is really quite varied. There is a lot of labor in some countries, and there's a shortage of labor in others. So I think for us, it's really the borders need to open so that the people can come back to work, because some of them were laid off. And also the governments need to give out the work visas.
Okay, is it still relevant, Richard?
I think it is for our region, and I'll be brief, Russell. I believe that in countries like Mexico, where where we don't have a labor shortage, where we do have greater efficiencies, like Mandeep described, but where in leisure markets specifically, they tend to be dollarized, there's a great appetite for investment. And I think there's an opportunity for that trend to carry over into other countries of the region and perhaps other countries in the world.
Okay, I'm going to go back to our distinguished audience. Have the HVS forecasts taken into account the potential shift in corporate travel, given the trend of work from home or hybrid work models that appear to be the new normal? If not, what could be the impact of changing corporate travel trends on hotel valuations? Do we have any valuers here? Monique, are you a valuer? Of course you are. Why didn't you answer that one?
Can you, sorry, I lost sound there for a minute.
That's a good one. That's a great one.
No, please.
So, what could be the impact of changing corporate travel trends on hotel valuations? So those arise from people who are working from home or only going into their offices one day a week or something like that, whatever the new normal is, whatever corporate travel evolves to be. That's the question.
Thank you. So in terms of corporate travel, there's no question that technology is going to impact it with meetings happening over Zoom, Teams, etc. But if there is a decrease in office space because people are working from home, corporations may need additional meeting space, which would definitely, a hotel would be the place for that. So there's no question that the hotel industry always has to evolve and morph, and it will reinvent itself. There's a lot of unaccommodated demand that's been out there, so that may be taken in. But I do think that in terms of hotels, they will reinvent the demand in some way, shape, or form.
Okay, I will invite...
So i.e. no impact on valuations.
Okay, anybody disagree with that? Okay, I've, again, left field for most of you. Are any of the hotel companies really tackling the ESG agenda in a meaningful way? Not just window dressing during earnings calls, but real impactful initiatives. Anybody want to kick off on that? Or is it all window dressing?
I can only say this from the Indian perspective, and I'd said this in one of the earlier sessions as well. I do believe that there's a lot of window dressing and not serious sustainability efforts, at least as of now. We're also not seeing the customer pay top dollar or the premium for sustainability in a very, very significant manner. And I speak for India and South Asia.
Okay. Anybody want to jump in on any other aspect of that question? Otherwise, I shall move on to the next one. So revenues are recovering, but service levels are not. We've heard that a recurring theme. Do you have any view on the impact of on future values given declining service levels? And who will be the winners in service recovery, leading to faster value recovery? Anybody want to take that one? Otherwise, I'll choose someone.
Russell, if I could, this is...
Go ahead, Vicki.
Go ahead, Vicki.
I obviously not speaking to values, but I just want to quickly speak to service restoration, is that it is coming back. There's a great many of the services have been back for a while now because guests have demanded it, competitive reasons. We're struggling to staff that service for sure. So they're not all as back to the extent that the guests want, but and guests, some are going to, let's say decline housekeeping, but they've been very vocal about expecting it to be available, concierge levels and so forth. So I'm not sure that the savings is going to be there because I think these are all going to be restored.
So Monique, you wanted to add something?
Yes, I think what we're going to see is more a la carte choices in terms of the service levels, because we're competing more with Airbnb and Sonder. And so people that want to have their room cleaned every day will be willing to pay extra for it. Those that won't. And so hotels are just going to have to be more flexible in the level of service that they offer to keep the clientele.
Okay. Moving on. This is for Eric. I think CMBS deals have had very small percentages of hotel conduit loans in the last year. Is this due to investors kicking these loans out or lack of financing to originate these loans? Eric?
Yeah, I think it's just a lack of cash flow for the hotels. So within the CMBS realm, there's no other collateral other than the hotel itself. So the lenders need to have an in-place cash flow to ultimately support a good rating when they go and sell it on the secondary market. And the majority of hotels just have not had a good in-place T12. And so we've started to see some CMBS originations this year. It's for assets that are not in top 25 markets. They're suburban, interstate, good branded assets that did not see a significant performance decline. Those were originated by CMBS lenders. And I think you'll start to see it open up more and more.
Okay. And whilst we're with you and giving you the microphone, I have a question on macro. We're all focused on micro. Here's a question macro. What about what might be happening at a macro level, starting of QE, quantitative easing, tapering, potentially rising interest rates as it impacts cap rates and the spread to hotels? Any thought on that, Eric?
Yeah, my thought is I think all the equity is going to continue to ultimately drive pricing higher. And so, yes, I think, the inflation, the rise in interest rates ultimately, may impact the transaction market from a pricing perspective, but it's not going to surpass all the investor demand. So my take is I don't think it's going to have a sizable impact on value.
Anybody want to add anything from a different perspective or somewhere else around the world? Otherwise, I shall move on. A quick question. A yes or no answer. Which hotel type will return to 2019 performance levels first? Full service hotels in major urban markets or large convention hotels? Who wants to answer that? Hands up. No, if you don't put a hand up, I've got to choose someone.
Well, sometimes they're much one and the same, because a significantly large full service hotel in an urban market is going to have 40 to 60% of its business being driven by group. So you can't just call one or the other. I think they really go in tandem. And like I said before, they're going to be the last to recover, but will. Okay.
And one other question that I would just like a very quick answer to before, sadly, we start to bring this to a close and I ask you my last question. What I would like to just understand, a very quick answer, if you can, will housekeeping and other services return to pre-pandemic norms, or are we going to find that hotels and Airbnb become synonymous with each other? Are they going to merge into one, or are we going to actually go back to delivering service in hotels, such as through housekeeping and other related services? Quick words round the globe. Mandeep.
Oh, certainly, I think hotels will have to continue to be the differentiator, and housekeeping services will return. They could be modified and there could be differentiation between limited service and full service, but housekeeping services will certainly return.
Okay, Kirby?
I am going to defer to Vicki on this one because she's given it a lot of thought.
Okay.
Well, I sort of addressed this earlier. It's just, I absolutely, look, guests have demanded, they've been very vocal. We're charging in some places very high rates and they're not getting the same services, and we're hearing about it, and it will all be back. There is no question. Monique's absolutely right. In some places we'll end up charging a different, a tiered structure, but the services, and maybe even more, will be back. We are in the hospitality industry.
Anybody think it's going to be different? Okay.
I have something to add.
I think it's going to be different.
I think housekeeping is is kind of a discrete dimension. The farther away that you move from the U.S., the more important the role of other roles of the hotel become. Fire and life safety, security, other issues that provide to differentiate hotels from Airbnbs. And so while that may be taken for granted, some of those things may be taken for granted in US housing, they're not taken for granted when you leave the US. And so the hotels do a lot more for you and it's less comparable to an Airbnb.
Okay, Glenn, you wanted to bring this to a close?
Yeah, I was going to say, I mean, I don't think it's going to go back. I think, one of the things that I mentioned, some evidence of it, is we saw what Host is already doing. Now, I don't think they're only doing that from a near-term cost perspective, saving perspective. Even Jeff Bellotti, who's CEO of Wyndham, said to Wall Street analyst recently that he thinks that housekeeping trend is here to stay. But I think it was Monique's point, and Vicki reinforced it, that I think they'll have the ability to, choose their service from an a la carte perspective. And certainly at the higher end of the hotel industry, ultra luxury, those services probably will be provided. But I think it's a dynamic that's more likely here to stay.
Okay. So, ladies and gentlemen of the panel, I want to thank you. I want to ask you one final question, and I want it literally one sentence and no more than one breath, okay? You have to choose a unique response, and because I'm a male chauvinist pig, I'm going to allow the women on our panel to have first bite, which only means that some people might have to think on their feet and change their minds at the last minute to go from plan A to plan B to plan C. That's your problem. Based on your own experience and given everything we've discussed in today's webinar, what is the single piece of advice that you would like to share with our delegates as to the best way to improve their hotel's value over the next 6 to 12 months? So, one sentence, one breath, one idea. Sophie.
Training and retention of employees.
Hock.
Reevaluate their target markets.
Halla.
Look at the idle space and consider other income streams.
Monique.
Establish really good relationships with local hotel schools.
Vicki.
Try to sustain the efficiencies we've achieved in expenses during the pandemic, and with these creative approaches to operations and frankly, what we used to consider to be fixed costs, try to sustain that going forward.
Congratulations on having the biggest lungs of anybody. Kirby.
I think it's important to really evaluate the quality of the leadership that middle managers provide over line level employees to minimize turnover of employees.
Okay, Eric.
For the branded hotels, make sure that the property is being renovated in compliance with the brand standards.
Mandeep.
We have to have a new mantra included in the way we measure performance. We've done Revpar, we've done Trevpar, we've done GoPar. It's now got to be also revenue per square foot or revenue per square meter.
Thank you, sir. Richard?
In your analysis, focus on the difference between this recovery period and what you consider will be structural changes in the industry. Those will be driven by how people come back to work and by a closer drill down on an evaluation of who travels for what reason.
Thank you. And Glenn?
Continue to reward those employees that are outperforming and keep them happy.
And finally, Rod?
Just get back out to reestablish local account relationships and have those one-on-one, face-to-face meetings with the businesses that are around you.
Wonderful. Ladies and gentlemen of our delegates, please join me in thanking all of our panelists today, all of our speakers. And with that, I hand you over back to Chris Shepherdson, who together with Stephen Rushmore will bring our webinar to a close. And I wish you all a very happy rest of your day. Thank you all very much indeed.
Thank you, Russell. That was excellent. And congratulations to all the speakers. I think there's some incredibly good insight there and great content. And it's fascinating to me, it's been fascinating listening to all the differences across the world, the global differences, but also the similarities that the same trends do emerge right across all the various different regions. Some exceptional insights and presentations by the team throughout the day. So my thanks to that. And we're clearly looking at a 3 to 4 year recovery back to 2019 levels. It's clearly going to be a road that's going to be tricky on the way out, but at least we seem to be on the right road, and there's light at the end of the tunnel, and there's growing optimism, which is obviously important. The industry is obviously at the same time, listening to all the speakers, the industry is going to have to change and evolve in different ways. The people issue is clearly right at the heart of all our concerns right across the world. And again, we're going to have new thinking and new ideas on that as we emerge. So it's going to be an interesting time, but as I said, we seem to be on the road to recovery. So thank you again to everyone for their input today. And with that, can I pass on to Stephen Rushmore, President and Chief Executive of HVS, to close. Stephen, over to you.
Thank you, Chris, and thank you to all the panelists, especially those who have done 3 of these calls throughout the day and night and early morning around the world. I thought this was a fantastic hour and a half, frankly, and thank you, the participants, for submitting questions. We had a lot of excellent questions and good responses to those questions as well. If for whatever reason we didn't get to your question, or perhaps you were shy to put it into the chat box, feel free to reach out to any of our colleagues here. We'd be happy to assist you. As well as we'll be providing additional content as a follow-up to the seminar with copies of the slides and a copy of this recording, so you can re-review it if you need be. So that's it. Thank you so much. Take care, be well, and stay safe.